October 10th, 2025. XRP holders watched in horror as their portfolio value evaporated by 42% in mere hours. $1.77. That's where XRP bottomed after crashing from $2.80. $700 million in trader positions wiped out. $35 billion in market cap vanished. This wasn't just another crypto dip. This was a full-blown flash crash that shook the entire market. And if you're holding XRP right now or thinking about buying the dip, what I'm about to reveal will completely change how you see the situation. Beyond the noise, find your clarity. This is smart money sense. Let me take you inside the chaos of October 10th. At market open, XRP was trading at $2.80. Normal volatility, normal volume. Then something unprecedented happened. Within the span of just a few hours, XRP plummeted to $1.77. Think about that for a second. A 42% intraday crash. This wasn't a gradual decline. This was a vertical drop that caught even experienced traders completely off guard. The volume tells the real story. On a typical day, XRP sees around $7.9 billion in trading volume. On October 10th, that number exploded to $18.7 billion. That's 2.4 times the normal volume. When you see volume spikes like that, you're witnessing pure panic. But here's what makes this crash different from your typical crypto correction: the recovery. By the next day's close, XRP had bounced back to $2.38. That's a 34.64% recovery from the absolute low. So what really happened here? Was this just random market chaos, or were there specific catalysts that triggered this unprecedented volatility? The answer is far more complex than most people realize, and understanding these factors could be the difference between massive losses and strategic opportunities. If you're finding this analysis valuable, smash that like button right now. And make sure you're subscribed with notifications on, because XRP's story is far from over. And I'll be breaking down every major development as it happens. There's still so much more to uncover about this crash. Let's talk about the $700 million elephant in the room. When XRP crashed, it triggered one of the largest liquidation events in the token's history. $709 million in total liquidations. But here's where it gets interesting. 616 million of that came from long positions. Only 92 million came from shorts. What does this tell us? The market was massively over-leveraged to the upside. Traders were betting big on XRP continuing its climb, using margin and futures contracts to amplify their gains. When the crash hit, these leveraged positions got automatically liquidated by exchanges to protect against further losses. Each liquidation created more selling pressure, which triggered more liquidations, creating a cascading effect that amplified the crash. Institutional futures open interest dropped by $150 million in a single day. From $9 billion down to $8.85 billion. That's not retail panic selling. That's institutional money rapidly de-risking their XRP exposure. The pros saw something that made them hit the exit button hard and fast. But liquidations alone don't create a 42% crash. There had to be an initial catalyst, something that sparked the fire. And when we dig into what happened in the hours before the crash, we find a macroeconomic bombshell that sent shockwaves through every risk asset on the planet. October 9th, 2025. President Trump announces 100% tariffs on Chinese imports. The crypto market, already jittery from regulatory uncertainty, went into full risk-off mode. Why would tariffs on Chinese goods crash a cryptocurrency? Because markets don't operate in isolation. When major macroeconomic shocks hit, capital flows out of speculative assets and into safe havens. XRP, despite its utility in cross-border payments, is still classified as a risk asset by most institutional investors. The tariff announcement created a perfect storm. Institutional algorithms started dumping risk assets across the board. The broader crypto market lost nearly $20 billion in market capitalization within hours. Bitcoin, Ethereum, Solana all saw significant drops. But XRP got hit harder than most. Why? because XRP had 3 additional vulnerabilities that other cryptocurrencies didn't face at that exact moment. First, whale distribution pressure. On-chain data revealed that in the week leading up to the crash, 320 million XRP tokens were transferred to exchange wallets. When whales move tokens to exchanges, it typically signals intention to sell. And sell they did. Analysis shows XRP whales had been maintaining a negative flow of $50 million per day for the past 30 days. That's consistent, relentless selling pressure building up like a dam ready to burst. Second, the ETF delay factor. Multiple asset managers, including Grayscale, Franklin Templeton, Bitwise, WisdomTree, 21 Shares, and Canary Capital, had all filed for XRP exchange-traded funds with deadlines between October 18th and October 25th. The U.S. government shutdown threw all of these into uncertainty. The SEC's operations were halted due to limited resources. For investors who had been pricing in potential ETF approvals, this was devastating news. Stay with me because what I'm about to reveal about XRP's technical levels will give you the exact price points that could determine whether this recovery continues or completely falls apart. But first, hit that subscribe button and drop a comment telling me, did you buy the XRP dip or are you waiting for lower prices? Third, Ripple's banking charter drama. Ripple has been pursuing a U.S. national banking charter, which would be huge for institutional adoption. But the Independent Community Bankers of America filed a 7-page opposition letter, citing concerns about regulatory circumvention and Ripple's compliance history. The deadline for the National Trust Charter passed on October 7th, just days before the crash. This added another layer of regulatory risk premium to XRP's price. When you combine macroeconomic shocks, whale selling pressure, ETF delays, and regulatory uncertainty, you create the perfect conditions for a flash crash. But here's what separates smart money from panic sellers: understanding where the actual value zones lie. And that requires technical analysis that goes beyond just looking at a price chart. Let's talk numbers. Current XRP support levels sit at $2.30 to $2.35. This is exactly where institutional buyers stepped in during the crash. It's also where we saw that massive volume spike. When you see buyers absorbing $18.7 billion worth of selling pressure at a specific price level, that level becomes significant. If volume decreases and selling pressure continues, the next major support sits at $2.22. Below that, we're looking at a potential retest of the crash lows. Not impossible, but it would require another significant catalyst. On the upside, XRP faces immediate resistance at $2.84 to $2.90. That's the pre-crash support that turned into resistance. Classic technical pattern. Break above $3.05, and we could see a momentum shift back to bullish. The major resistance cluster sits at $3.30 to $3.40. Technical indicators paint a mixed picture. The Relative Strength Index at 28.6 suggests XRP is in oversold territory. Historically, this can be a buy signal, but moving averages across all time frames are showing strong sell signals. This creates what traders call a conflicting signal environment. It means the market hasn't decided its next direction yet. Here's what most people missed during the chaos. Institutional participants didn't panic, they recalibrated. In the final trading hour of October 10th, sustained bids and accumulation volumes exceeded 12 million XRP. That's not retail FOMO. That's institutional accumulation at strategic price levels. Why would institutions buy during a crash? Because they have longer time horizons and deeper fundamental analysis. They're not trading daily volatility. They're positioning for medium to long-term catalysts. And XRP has several major catalysts on the horizon that could dwarf this crash in terms of positive impact. The RLUSD stablecoin is one of those catalysts. Ripple's stablecoin reached a market cap of $789.45 million by September 2025. It's integrated with major financial institutions, including BNY Mellon as primary custodian. Ripple processed $1.3 trillion in cross-border transactions by Q2 2025. These aren't small numbers. This is real-world utility at institutional scale. RLUSD creates what analysts call a flywheel effect. Increased stablecoin adoption drives XRP demand as a bridge asset. Financial institutions using RLUSD for settlements need XRP liquidity. More demand, controlled supply, and you've got fundamental price support that has nothing to do with speculation. We're almost at the end, but I need you to do two things. First, check out the video appearing on your screen right now, where I break down the top 3 cryptocurrencies positioned for massive gains in 2025. And second, subscribe to this channel so you never miss critical analysis like this. The crypto market moves fast, and being informed is your biggest advantage. So what's next for XRP? Let's separate speculation from analysis. Conservative price projections put XRP in the $4 to $6 range if ETF approvals materialize once government operations resume. That's based on historical ETF approval impacts on other cryptocurrencies and XRP's current market dynamics. Optimistic scenarios push $8 plus if multiple positive catalysts align. We're talking ETF approvals, banking charter resolution, continued RLUSD adoption growth, and favorable regulatory clarity under new SEC leadership. All of these are possible, but they're also uncertain timeframes. Bearish scenarios can't be ignored. If whale selling pressure continues and macroeconomic conditions deteriorate further, there's risk of testing that $2.22 support level I mentioned earlier. Break below that, and we could see a retest of the crash lows around $1.77. The key for any investor, whether you're institutional or retail, is risk management. XRP's 42% flash crash proves this token can move violently in both directions. If you're holding XRP, position sizing matters. If you're considering buying, dollar cost averaging into these levels makes more sense than trying to catch the exact bottom. Step back and look at the bigger picture. The October 2025 flash crash, while dramatic, fits within XRP's historical volatility patterns. Major corrections have often preceded significant rallies, particularly when accompanied by whale accumulation at lower levels. We're seeing that accumulation right now. The crash also revealed something important about market structure. Despite $700 million in liquidations, despite 42% intraday drops, despite massive panic, XRP recovered 34.64% within 24 hours. That's not the behavior of a dying asset. That's the behavior of an asset with strong underlying demand and institutional support at specific price levels. Regulatory developments will be the wild card. XRP's fate is more tied to regulatory clarity than almost any other cryptocurrency due to Ripple's business model and institutional partnerships. The SEC's stance, banking charter decisions, and ETF approvals will move XRP more than any technical pattern or whale transaction. The XRP crash of October 10, 2025 will be studied for years as a case study in crypto market dynamics, liquidation cascades, and the interplay between macroeconomics and digital assets. For those who panicked and sold the bottom, it was an expensive lesson. For those who understood the underlying dynamics and accumulated at support levels, it was an opportunity. You've just gotten one step smarter about XRP's crash and what it means for the future. But your crypto education doesn't stop here. Click that video on your screen. Subscribe to Smart Money Sense so you never miss insights that could make the difference in your portfolio. And drop a comment below with your biggest takeaway from this analysis. Are you bullish or bearish on XRP? Let's discuss in the comments. Keep building your sense.